Welcome to the Deep Dive. We're the show that takes a whole stack of sources, breaks them all down, and basically gives you the essential insights you need. So, have you ever looked at a business and just wondered what actually makes it stable, predictable? Not just flashy for a bit, but built to really last and grow. Well, today we're doing a deep dive into precisely that. We're looking at the key metrics, monthly recurring revenue MRR and its big brother, annual recurring revenue, or ARR. Our mission really is to unpack these, cut through the jargon, and show why they aren't just numbers on a spreadsheet. They're more like diagnostic tools for companies' health. It's future even. And we're drawing all this from a really great key metrics guide.
Yeah, that's exactly right. I mean, if you want to understand the financial pulse, the sustainability, the growth potential of a subscription businesses, SaaS companies, these metrics are, well, fundamental. So this deep dive, it's really a shortcut for you to get properly informed about a core concept in, modern business.
Okay, so if these are like the heartbeat, let's get a clear reading. What exactly are MRR and ARR? Let's start there.
Right. So monthly recurring revenue, MRR, it's pretty simple, actually. It's the consistent, predictable revenue a business gets each month, specifically from active subscriptions, that reliable income stream.
Okay, predictable monthly from subscriptions. Got it.
And annual recurring revenue, ARR, just builds on that. It projects that monthly recurring revenue out over a whole year, gives you that longer-term view, which is, crucial.
Okay, that makes sense. And our source material really hammers this point home, what's not included, like one-time payments, setup fees, consulting gigs.
Exactly.
Why is that focus strictly on the recurring part so critical? I mean, what's the danger if companies start fudging those lines?
Oh, it's absolutely critical because, well, it forces honesty about the foundation. Big one-time payments can easily hide the fact that your actual subscription base might be shrinking. It can make a company look healthy when the core engine is actually sputtering out.
I see. So it's about true underlying health.
Precisely. Focusing only on recurring means MRR and ARR let businesses track their ongoing financial performance accurately. They help understand retention, real growth speed, and whether current strategies are, actually sustainable and profitable. And something often missed, it's not just about forecasting internally. For investors, solid MRR growth is maybe the best signal of product market fit. Way better than, say, lumpy one-off sales. It really shows strength.
Okay. That makes a lot of sense. It's about the reliable core. So let's get practical then.
Right.
How do you actually calculate these numbers? What's the math look like?
Well, the calculation for MRR, monthly recurring revenue, it's pretty straightforward.
Yeah.
You just sum up the revenue from all your active paying customers on a monthly basis. So the guide gives this example. Say you have 10 customers paying $100 a month and another 5 paying $200 a month. Your MRR is, $1,000, so $2,000 for that month.
Right. Just add up all the monthly subscription fees from paying customers. Simple enough.
Yeah. And then annual recurring revenue, ARR, is even simpler. It's just your MRR times 12. So using that same example, if your MRR is $2,000, your ARR would be $24,000.
So $24,000.
Got it. Now, that's obviously a straightforward projection. It assumes no one leaves, no one upgrades, basically no changes. But it gives you that quick annual snapshot.
Okay, but as you hinted, the total MRR is maybe just scratching the surface. The source guide says the real insights, the diagnostic power comes from breaking it down. So what are these components?
Exactly. This is where it gets really useful. You need to look at 4 key categories to see what's really happening with your revenue. First, you've got new MRR. That's pretty intuitive. It's the additional monthly revenue from brand new customers you acquired in that month.
Okay, new customers signing up.
Right. So if you sign 5 new people, they each pay $100 a month.
Yeah.
That's $500 in new MRR.
Simple enough. What's next?
Second is expansion MRR. Now, this one's really interesting. This is extra revenue from your existing customers.
Existing customers, how?
Well, they might upgrade to a higher plan or buy an add-on feature or add more users. Basically, they spend more per month than they used to.
Ah, okay. Upsells, cross-sells within the existing base.
Exactly. Like if someone goes from a $50 plan to a $100 plan, that extra $50 is expansion MRR. And honestly, strong expansion MRR is often seen as a gold mine.
Why is that?
Because it's usually cheaper to get more revenue from existing happy customers than acquiring new ones. Plus, it shows your product is sticky and delivering ongoing value. They want more of it. Huge validation.
Right, that makes sense. Okay, so new MRR, expansion MRR. There must be downsides too.
Yes, unfortunately. Third is contraction MRR. This is the flip side of expansion. It's revenue you lose when existing customers downgrade.
Downgrade, like moving to a cheaper plan.
Exactly. If a user drops from that $100 plan back down to the $50 plan, you've lost $50. That's contraction MRR for the month.
Okay, downgrades. And the last one must be...
Churned MRR, the one everyone dreads.
Yeah.
This is the revenue you lose completely when customers cancel their subscriptions altogether.
They just leave.
Yep. So if two customers, each paying $100 a month, cancel, that's $200 in churned MRR that month. Gone.
Wow. Okay, so new, expansion, contraction, churn, lots of moving parts. So how do you boil all that down to see if you're actually, winning or losing overall each month?
That's where net new MRR comes in.
Oh.
It's the bottom line for the month's recurring revenue change.
Net new MRR, how's that calculated?
You take the good stuff, new MRR and expansion MRR, add them together. Then you subtract the bad stuff, churned MRR and contraction MRR.
So new plus expansion, churn plus contraction.
Exactly. That final number, your net new MRR, tells you very clearly if your overall monthly recurring revenue is growing or shrinking. It's the ultimate health check for the month.
Okay, that calculation is super insightful. So once you have these numbers, the total MRR, ARR, and these components, what do they actually tell you? Like, what are the benchmarks? What signals a healthy business versus maybe one that's struggling?
Right. The interpretation is key. So different trends signal different things. For, say, an early stage SaaS company, seeing monthly NRR growth between 10% and 20%, that's generally considered pretty healthy, solid growth.
10 to 20% per month.
Okay. Yeah. But if your MRR is flat, or worse, declining, that's a major red flag.
Why? What could that mean?
Well, it could point to problems with acquiring new customers, or maybe you're not keeping the ones you have. Maybe the product just isn't delivering enough value anymore. Lots of potential issues.
And what about churn?
Churn. If your churned MRR is consistently high, it means customers are leaving too quickly. That could be, well, anything from a poor onboarding experience to the product not fitting the market well, or maybe just inadequate customer support.
So high churn is a big leak in the bucket.
A huge leak. But conversely, like we touched on, strong expansion MRR, that's an incredibly positive signal.
Because existing customers are spending more.
Yes, but it's more than that. It means they're finding increasing value. They're embedding your product deeper into their workflow. It's often the absolute best sign that you've really nailed product market fit and you have a healthy, sustainable growth engine.
That makes sense. It shows real value delivery over time. Okay, this brings up a question for me. Who actually uses these metrics day to day? I mean, besides the finance team or maybe investors looking from the outside?
Oh, good question. They're actually used across the board in healthy subscription businesses. Think about product managers.
Okay, product folks. How?
Well, they use MRR changes, especially expansion or contraction, to directly link feature adoption or improvements to actual revenue impact. Did rolling out that new feature reduce churn? Did it drive upgrades? MRR tells them.
Tying product decisions to dollars. I like it.
Exactly. And founders, they live and breathe MRR. They use it to gauge their startup's runway.
Yep.
How many months they can operate before needing more cash.
Right. Survival metric.
Totally. And it helps them plan hiring, decide when to try and raise the next funding round. It's strategic.
Makes sense. Anyone else? Marketers.
Oh, definitely marketers. They track MRR, particularly new MRR coming from their campaigns, to figure out the actual ROI. Are their efforts just bringing in leads, or are they bringing in quality leads that stick around and become paying recurring customers? MRR helps prove that value.
So it connects marketing spend directly to sustainable revenue.
Very cool. Okay, so for someone listening who maybe wants to start tracking this properly, or maybe improve how they do it, what tools are out there? And crucially, what are the common mistakes people make, the pitfalls to avoid?
Right, practicalities. Well, the good news is there are some great tools. For the actual billing and subscription management side, which is fundamental to tracking, you've got big players like Stripe, Chargebee, Paddle. They handle the payments and often have MRR reporting built in.
Okay, the payment platforms themselves.
Yeah. Then, if you want more dedicated dashboards specifically for visualizing MRR, ARR, churn, all those components we talked about, there are tools like Barometrics, ChartMogul, ProfitWell. They often integrate with the payment platforms.
Specialized analytics tools. Exactly. And hey, if you're just starting out, bootstrapping maybe, you can actually rig up a pretty decent tracker using Google Sheets combined with something like Zapier to automate pulling data. It's cost effective.
Good to know there are options for different stages. Now, the mistakes. What should people watch out for?
Okay, common pitfalls. Number one, absolutely, including one-time payments in your MRR. Setup fees, consulting, training. Don't do it. It inflates your recurring revenue figure and gives you a false sense of security.
Stick strictly to recurring subscription fees. Got it.
Second big one, counting trial users, or like deals that are verbally agreed upon but haven't actually closed and paid. Only count paying customers in your MRR calculation.
No wishful thinking. Only count the cash coming in reliably.
Precisely. And the third one, which can really skew things, is failing to meticulously track and subtract downgrades, contraction MRR, and cancellations, churned MRR. If you only focus on the new and expansion revenue, you're getting a dangerously optimistic picture.
You need the full picture, warts and all, the net change.
You absolutely do. Overlooking contraction and churn leads to overestimating performance, which can lead to really bad strategic decisions down the line.
Wow. Okay, this has been incredibly illuminating. It really drives home how foundational MRR and ARR are. And yet, like you said, how easily they can be miscalculated or maybe misinterpreted. They really do seem like the bedrock for subscription businesses.
They absolutely are. You know, MRR gives you that vital monthly pulse check, lets you see the immediate trends, while ARR provides that crucial long-term strategic view, super important for investors. Yes, but also just for your own long-range planning.
Right, the monthly heartbeat and the annual forecast.
Exactly. And like we dug into, segmenting MRR into those components, new, expansion, contraction, churn, that's where the real diagnostic power comes in. It lets you pinpoint exactly what's driving growth or what's holding it back. You see the levers you can pull.
Yeah, that breakdown seems incredibly powerful.
And, for a final thought, these metrics become even more powerful when you start combining them with other key business indicators. Things like your churn rate as a percentage, your customer acquisition cost CAC, basically what it costs you to get a new customer, and customer lifetime value, LTV, which is the total revenue you expect from a customer over their entire relationship with you.
Ah, connecting the dots.
Yeah. When you look at MRR alongside CAC, LTV, and churn rate,
Mm.
then you start to get a truly comprehensive, like a 360-degree view of a company's financial health and its overall business model viability.
That's a fantastic point to end on. It really paints a picture of a dashboard for business health. So maybe something for you, the listener, to think about. How does understanding recurring revenue change how you look at the businesses you use every day? The streaming services, the software, the subscription boxes, you start to see past just the surface, right? You can start to appreciate that predictable, sustainable engine or maybe lack thereof that's driving their growth or perhaps holding them back. It's a different lens to view the business world through.